There's a version of real estate investing that gets glamorized constantly. You buy a rental property, tenants pay your mortgage, the property appreciates, and you sit back collecting passive income while building equity. It sounds simple. It sounds obvious. And for some people, in some markets with the right circumstances, it genuinely works. Then there's the other version. The version where your tenant stops paying rent in month 4 and the eviction process takes 8 months. The version where the furnace dies in January and costs $6,000. The version where you spend your Saturday driving to the property because the upstairs neighbor flooded the bathroom and your tenant is threatening to sue. The version where you refinanced your own home to make the down payment and you're now one bad quarter away from financial distress. My name is Eddie and I spend way too much time thinking about money, assets, and the gap between what investing in something sounds like and what it actually involves. If you want real estate in your portfolio without the nightmare of being a landlord, there's a vehicle specifically designed for that. It's called a REIT, and most people with any interest in real estate should understand how it works. Hit subscribe and give this a thumbs up if it ends up being useful. If you've ever thought about buying a rental property but felt overwhelmed by the logistics, this is exactly the video for you. Hit the like button. REIT stands for Real Estate Investment Trust. It's a company that owns, operates, or finances income-producing real estate, everything from apartment complexes and office buildings to warehouses, data centers, hospitals, shopping malls, and cell towers. And you can buy shares in these companies on the stock market the same way you'd buy shares of Apple or Amazon. What makes REITs structurally unique is a legal requirement built into how they're classified. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders as dividends every year. This means REITs are, by design, income-generating investments. They can't retain most of their earnings and reinvest them. They have to pay them out. This is why REIT dividend yields tend to be significantly higher than the typical S&P 500 companies, often somewhere between 3 and 6% annually, sometimes more depending on the sector. The historical performance of REITs is genuinely impressive. The FTSE NAREIT All-Equity REITs Index has historically produced total returns, dividends plus appreciation, that are competitive with or slightly above the overall stock market over very long time horizons. Some research suggests REITs have outperformed the S&P 500 on a total return basis over certain 20-year and 30-year periods, particularly when dividends are reinvested. The data here is debated depending on the time period you choose, but the bottom line is that REITs are not a significantly inferior asset class to broad equities, they're a legitimate wealth-building vehicle. The diversification argument for REITs is also real, though it's become less compelling in recent years. Historically, real estate returns had low correlation with stock market returns. They moved somewhat independently, which meant adding REITs to a stock portfolio would reduce overall volatility without sacrificing much return. In more recent market cycles, however, REITs have shown a higher correlation with equities, particularly during broad market crises when liquidity dries up and investors sell everything simultaneously. The diversification benefit is real but smaller than it used to be. Let me explain what you're actually investing in when you buy REITs. There are several major categories. Equity REITs own physical properties and earn revenue from rents. This is the most common and most straightforward type. Mortgage REITs, called mREITs, don't own physical properties. They provide financing for real estate by buying or originating mortgages and earning the spread between their financing cost and the interest on loans. Mortgage REITs are considerably more complex and interest rate sensitive than equity REITs and behave more like bond investments than property investments. If you're learning something new here and want to keep going, hit the like button and subscribe. I cover asset classes like this regularly and try to give you the real story, not just the pitch. Within equity REITs, there's a wide range of subsectors with very different characteristics. Residential REITs own apartment buildings and single-family rental portfolios. Industrial REITs own warehouses and logistics facilities. This sector has performed particularly well as e-commerce has driven demand for distribution space. Healthcare REITs own hospitals, medical office buildings, and senior living facilities. Retail REITs own shopping malls and strip centers. Data center REITs own the physical infrastructure that powers cloud computing. Cell tower REITs own the towers that support wireless networks. Each subsector has different risk profiles, growth drivers, and yield characteristics. Industrial and data center REITs have been strong performers in recent years due to structural economic tailwinds. Retail REITs have faced significant headwinds from e-commerce disruption. Residential REITs have benefited from housing affordability challenges driving rental demand. Understanding which subsectors you're getting exposure to matters if you're buying individual REITs rather than a diversified REIT fund. Now let's talk about the real advantages of REITs over physical property ownership. Liquidity is the obvious one. If you own a rental property and you need cash, selling it takes weeks or months, involves transaction costs of 5 to 8%, and requires finding a buyer at a price you agree on. If you own shares in a REIT, you can sell them in seconds at the current market price during any trading day. This flexibility has enormous practical value that gets overlooked in comparisons between REITs and physical real estate. Diversification is the second advantage. A single rental property gives you exposure to one market, one tenant, one building, and one set of risks. A REIT or REIT fund gives you exposure to hundreds or thousands of properties across multiple geographies, multiple tenant industries, and multiple property types. The specific failure of any single property barely affects your outcome. The management burden is zero. No tenants to deal with. No maintenance calls at 11 p.m. No property managers to hire and manage. No local code compliance to navigate. No property tax filings. No insurance policies to maintain. You own the investment. Professionals run it. Your involvement is limited to the same dashboard you use to track your other investments. The disadvantages are real too. REITs are taxed less favorably than stocks at the individual level because their dividends are typically classified as ordinary income rather than qualified dividends. This means if you hold REITs in a taxable account, a larger portion of your returns gets taxed at your marginal income rate rather than at the preferential 15 or 20% capital gains rate. The tax-efficient way to hold REITs is inside a tax-advantaged account like a Roth IRA or traditional IRA where the dividend income grows tax-deferred or tax-free. REITs are also interest rate sensitive. When interest rates rise, REITs tend to face headwinds for two reasons. Their cost of financing goes up, which pressures profit margins, and investors can get higher yields from safer fixed-income alternatives, which makes the REIT yield relatively less attractive. This is why REITs sold off sharply in 2022 alongside bonds when the Fed aggressively raised rates. The practical answer for most investors is that a modest allocation to a diversified REIT fund, somewhere between 5 and 15% of your equity portfolio, provides meaningful real estate exposure with none of the operational headaches of physical ownership and reasonable historical return potential. You get the asset class in your portfolio without the 3 a.m. plumbing emergencies. If this clarified how REITs actually work and why they deserve a place in a serious portfolio, share it with someone who's been avoiding them because they seem complicated. Subscribe if you're not already and hit that like button on the way out. See you in the next one.